Stop watching the war. Because what's happening right now in one narrow strip of water is quietly deciding what your money will be worth. If this breaks, the dollar doesn't just weaken, the system it runs on starts to fracture. There are places on this planet so vital, so geographically critical, that they act as the arteries of our world. If one of them gets blocked, the whole system starts to seize up. But what we are watching right now is different. This is not a military conflict. This is a live stress test of the global financial system. And for decades, one of these arteries has been more important than any other: the Strait of Hormuz. To really get what's happening in late March of 2026, you have to understand the physical reality of this place. The Strait of Hormuz is the only way for a ship to get from the Persian Gulf to the open ocean. It's a narrow channel of water, with Iran on one side and the Arabian Peninsula on the other. At its narrowest, it's only 21 miles wide. But that number is deceiving. The actual shipping lanes for the world's biggest supertankers, one lane in, one lane out, are each only 2 miles wide. 2 miles. That's it. A tiny sliver of water that a shocking amount of the world's energy has to pass through. Let's put some numbers on that so the scale really sinks in. In 2025, about 20 million barrels of crude oil and other petroleum products flowed through this choke point every single day. That's about a fifth of the entire world's oil consumption. Think about that for a second. 20% of the fuel that powers our cars, heats our homes, and runs our industries squeezes through this one vulnerable waterway. It's about a quarter of all oil that's traded by sea. And it's not just oil. The Strait is also the pipeline for nearly 20% of the world's liquefied natural gas, or LNG. Countries like Qatar and the UAE are almost totally dependent on the Strait to sell their gas. A lot of that gas goes to Europe, which counts on Qatar for up to 14% of its supply. For America's key allies in Asia, the numbers are even scarier. In 2025, an incredible 89% of the crude oil and 83% of the LNG that went through Hormuz was headed for Asia, to places like China, Japan, India, and South Korea. For these countries, the Strait of Hormuz isn't just a shipping lane, it's an economic lifeline. Nations like Iraq, Kuwait, and Qatar have no other way to export most of their oil and gas. Even the giants, Saudi Arabia and the UAE, only have limited pipelines to bypass the strait. Saudi Arabia can reroute about a fifth of its daily exports, and the UAE about half. The rest is stuck. This is why military strategists and economists have been holding their breath over the Strait of Hormuz for 50 years. They always knew that if this place was ever seriously disrupted, it wouldn't be a regional problem. It would be a global catastrophe, an economic heart attack. And for the past month, that is exactly what we've been watching. The system is being stressed in a way it has never been before. This crisis didn't just pop up overnight. It was the result of months of rising tension. The whole thing was set off by a series of protests inside Iran in early 2026, which the regime met with force. Then, on February 28, 2026, the situation exploded. The United States and Israel launched a coordinated series of surprise airstrikes on targets all across Iran. This military action was aimed at Iran's nuclear facilities and military command. In the chaos of the initial attacks, reports swirled that Iranian Supreme Leader Ali Khamenei was a primary target, with his fate remaining uncertain. The stated goal, according to US President Donald Trump, was to neutralize threats from the Iranian regime, and maybe even spark a regime change. But the immediate result was a furious and chaotic retaliation. Iranian forces launched hundreds of missiles and thousands of drones, targeting not just Israel, but US military bases and embassies all across the Middle East, in the UAE, Saudi Arabia, Qatar, Kuwait, you name it. And then they made the move the world had always feared. Iran's Islamic Revolutionary Guard Corps, the IRGC, turned its focus to the Strait of Hormuz. Now, here's what should happen in a textbook naval conflict: a declaration of a blockade, a clear act of war that would unite the world against them. But that's not what's happening. Instead, Iran started something way more complex and much harder to fight. They began a campaign of asymmetric warfare designed to make the strait basically impassable without ever officially closing it. They started deliberately messing with freedom of navigation. Reports of drone and missile strikes on commercial ships started pouring in. The IRGC issued warnings, forbidding ships from passing if they were headed to or from ports of the US and its allies. They started laying mines. Since the war started, there have been 16 confirmed attacks on ships in and around the Persian Gulf. The goal was obvious: make the area so dangerous, so unpredictable, that shipping companies and their insurers would just refuse to go there. And it worked. The number of ships passing through the strait each day, which is usually around 138, absolutely plummeted. Traffic dropped from that average, first down to the teens, and then to just one or two tankers trickling through every day. The few ships that still made the journey were either from countries Iran considered friendly, like China, or were reportedly paying massive fees in what some analysts started calling a toll booth system. Iran's strategy is a masterclass in modern warfare. They know they can't win a head-to-head naval battle with the US Navy. But Iran has geography on its side. A long, mountainous coastline that's perfect for hiding mobile missile launchers and drone crews. Their goal isn't to beat the US Navy. It's to make the price of keeping the strait open just too high to pay. As one analyst put it, it's a lot harder for a superpower to keep a waterway open than it is for a smaller power to just make it risky. Even one successful attack on a cargo ship can scare off dozens of others, because civilian shipping just can't tolerate that kind of risk. This is Iran's pressure gauge. By tightening and loosening this choke point, they aren't just fighting a war, they're putting direct and agonizing pressure on the global economy. Brent crude oil shot past $100 a barrel for the first time in years, even peaking at over $126. World leaders condemned Iran's actions, and on March 19th, the US military began a campaign to try and reopen the strait by force. But the damage was already done. The artery was clogged. The world had just seen a live demonstration of what happens when 20% of its daily oil supply just disappears. So what does this mean for your money right now? It means the cost of energy everywhere is going up, putting immediate inflation pressure on everything you buy. And it raises serious questions about the long-term strength of the currency you save in. But this is only where the story begins. The spike in oil prices is just a symptom. The real disease lies much deeper, in the very foundation of our financial system. Before we get into the plumbing of global finance, it's important to understand the real-world consequences of Iran tightening this strategic pressure gauge. This isn't some abstract theory. It's a crisis that's having a painful impact on businesses and families all over the world. The damage spreads in waves, starting with the industries closest to the action and spreading out to touch almost everything. The first shockwave, the one everyone feels almost immediately, is the cost of energy. With ship traffic in Hormuz basically grinding to a halt, a fifth of the world's oil supply was effectively taken offline. The result was a sudden and violent price shock. But here's the problem. Oil prices going up isn't the real risk. The real risk is what happens next. For every country that imports more energy than it produces, which is most of Europe and major Asian economies like Japan and India, this means the national energy bill just exploded. Governments are now stuck with a brutal choice: eat the cost and blow a hole in their budgets, or pass it on to people and risk protests and a recession. For the average person, this means pain at the pump. The price of gas and diesel is tied directly to the price of crude oil. As it costs more to get fuel to you, the price you pay to fill up your car goes up. And that, in turn, makes everything that needs to be transported more expensive. Groceries, electronics, clothes. If it moves by truck, train, or ship, its price is now going up. The second wave slams the shipping industry. With the Strait of Hormuz now a war zone, the cost of maritime insurance has shot into the stratosphere. Insurance companies now see the Persian Gulf as one of the most dangerous places on Earth to send $1 billion tanker and its crew. The war risk premiums for any ship that dares to enter the region have become almost impossible to afford. For a lot of companies, the risk just isn't worth it. Their only other option is to go the long way around. A tanker that would have gone from the Persian Gulf through the Suez Canal to Europe now has to take a much longer, much more expensive journey around the southern tip of Africa. This detour adds thousands of miles and weeks to the trip. That's more fuel burned, more wages for the crew, and more time the ship is out of commission. The system doesn't fail when prices fall. It fails when things stop moving. And this isn't just about oil and gas. A huge amount of global trade goes through that region. One thing people often forget about is fertilizer. About a third of the global trade in urea, the world's most common fertilizer, passes through the Strait of Hormuz. A disruption here means farmers in places like India or Brazil could face shortages or huge price hikes for what they need to grow their crops. The downstream effect of that is simple: higher food prices for everyone. The fourth wave is uncertainty. The global economy runs on predictability. Businesses make decisions based on what they think costs and demand will look like in the future. The Hormuz crisis throws a wrench in all of that. A car maker in Germany suddenly has to worry about higher energy costs and potential shortages of plastic parts. A big retailer in the US faces higher shipping costs for its products, forcing it to either take a hit on profits or raise prices on its customers. When this much uncertainty hits the system, businesses just pause. They delay expansions, they freeze hiring, they hang on to their cash to ride out the storm. This collective hesitation acts like a giant brake on the global economy, threatening to turn a slowdown into a full-blown recession. This is the immediate chaos caused by Iran's strategy. It shows how a local military action, when you apply it to a critical economic choke point, can hold the whole world hostage. But as bad as all this is, it's just the tip of the iceberg. The real, systemic danger is hiding below the surface. To really understand how serious the situation in the Strait of Hormuz is, we have to zoom out from the tankers and missiles and look at the invisible architecture that powers the global economy. And for the better part of a century, that architecture has been built on a single foundation: the US dollar. Think of the dollar as the world's financial operating system. It's the default setting for almost all international business. When Brazil sells soybeans to China, the price is in dollars. When South Korea buys oil from Saudi Arabia, the deal is settled in dollars. The dollar is the global currency that everyone trusts. This gives the United States what economists call an exorbitant privilege. Because the world needs dollars to trade, there's a constant artificial demand for American currency. This lets the US run huge trade deficits, buying more from the world than it sells, and pay for it with its own money. The whole system started back in the early 1970s. In 1971, President Nixon cut the final tie between the US dollar and gold. The answer to what backed the dollar came from a series of deals, especially one with Saudi Arabia. The agreement was simple. Saudi Arabia, and by extension OPEC, would price all its oil exclusively in US dollars. In return, the United States would provide them with military security. This was a masterstroke that created a permanent, built-in global demand for US dollars. This is the heart of the petrodollar system. Any country that wanted to buy oil had to get US dollars first. This cemented the dollar's role as the world's main reserve currency. Central banks all over the world had no choice but to hold huge amounts of US dollars and US government debt. This system gives the United States incredible geopolitical power. Because the world's financial plumbing runs on dollars, Washington can control who gets to use it through sanctions. By threatening to cut a country off from the dollar, the US can kick a nation out of the global economy. For decades, the system worked. The benefits of one stable currency were seen as worth the exorbitant privilege it gave the US. But that's not what's happening anymore. The foundation of this system has started to show serious cracks, and the events of March 2026 are acting like a sledgehammer to those cracks. If you're still watching headlines or price charts, you're missing how the system actually works. The very power that the dollar system gives the United States is now becoming its greatest weakness. Every time the US uses sanctions as a weapon, it sends a clear message to the rest of the world. Your access to the global financial system depends on you staying on Washington's good side. For countries that see themselves as rivals, this is a risk they can't afford. The conflict with Iran is the ultimate example. Iran has been under crippling US sanctions for years. Now, it's showing that even from the outside, it can inflict massive pain on the system itself. By disrupting the flow of oil through Hormuz, Iran is attacking the very commodity that holds up the whole petrodollar deal. This act of economic warfare is pouring gasoline on a fire that was already burning. De-Dollarization. This isn't a conspiracy theory, it is a stated policy goal of a growing number of countries. It's a slow, steady process of building new systems to rely less on the US currency and protect themselves from American sanctions. Just look at the countries most affected by the Hormuz crisis. China is the world's biggest oil importer. This conflict is a brutal reminder to Beijing that its energy security, the lifeblood of its economy, depends on a waterway policed by its main geopolitical rival. This is a weakness China simply cannot tolerate. The response has been a quiet but deliberate campaign to chip away at the dollar's power. We're seeing more and more trade agreements designed to bypass the dollar completely. Russia and China now conduct the vast majority of their trade in their own currencies. Brazil and China have a similar deal. These aren't just one-offs. They're the building blocks of a new, multipolar financial world. The BRICS group of nations, which now includes major energy producers like Iran, the UAE, and Saudi Arabia, alongside consumers like China and India, has made trading in local currencies a central part of its mission. They are developing their own payment systems, like BRICS Pay, to create an alternative to the SWIFT network. There is even serious talk among these nations about creating new forms of currency for trade, potentially backed by commodities like gold. But building an alternative is slow. A crisis like this, it's an accelerator, and it's forcing a choice that will define the next decade. The Hormuz crisis acts as a live fire drill, a real-world demonstration of the exact risks these countries have been worried about. When the US can start a conflict that threatens to cut off their energy supplies, the motivation to build non-dollar alternatives becomes a matter of urgent national security. The war in the Gulf isn't just about Iran. It's a stress test of the entire dollar-centric world order, and the results are showing that the system is a lot more brittle than anyone thought. So, what does all this mean for your money? If the global financial operating system is fracturing, what comes next? The answer will directly affect the value of your savings and the stability of your pension. The most likely future isn't one where the Chinese yuan simply replaces the dollar. The dollar's dominance is backed by deep capital markets and a level of trust that no other currency can match right now. Instead, we are probably heading towards a more fragmented and messy environment, a multipolar currency world. Imagine a future with several competing currency blocks. You'd have the dollar block, still powerful but with a smaller footprint. Then you might have a yuan block, used for trade between China and the many countries in its orbit. We could see other regional currencies become more important, maybe the euro for European trade, or even a new commodity-backed system for the BRICS nations. For global trade, this means more friction. The smooth, low-cost world we got used to under the dollar could be replaced by a clunkier system. A multinational company might have to manage its money in 3 or 4 major currencies. The cost of doing business internationally could go up. For the United States, Losing the dollar's exclusive status means the end of that exorbitant privilege. Without the world needing to constantly buy dollars, the US would lose its ability to fund its massive government and trade deficits so cheaply. The cost of borrowing for the US government would rise, as there would be fewer automatic buyers for its bonds. This would mean higher interest rates for everyone in the US, from mortgages to car loans. The economic discipline the US has been able to export for decades would finally come home. This transition won't be smooth. A shift in the global financial order is a huge event, and it will bring volatility and uncertainty. The crisis in the Strait of Hormuz is the kind of shock that can accelerate these changes. It's forcing nations to make hard choices about their economic security, pushing them down the path of diversification much faster than they would have gone otherwise. We're moving from a world with one financial sun to a world with multiple, smaller stars, each with its own gravitational pull. In this new world of currency competition, how do nations protect their wealth? When the main fiat currency is facing a long-term challenge, what do central banks turn to as a neutral store of value? The answer is as old as civilization itself: gold. For the past several years, we've been watching one of the biggest waves of central bank gold buying in modern history. After the 2008 financial crisis, central banks did a complete 180 and have been buying it up like crazy ever since. In the years leading up to 2025, they were buying at record-breaking levels. And who's doing the buying? The list tells you everything. It's dominated by the very countries trying to reduce their dependence on the dollar. China, Russia, India, Turkey, and a host of other emerging markets have been leading the charge. But it's also happening in Europe. Poland has been aggressively adding to its gold reserves, citing geopolitical risk. A 2025 survey by the World Gold Council showed that an overwhelming majority of central banks plan to keep buying gold. Their reasoning is clear. First, gold is the ultimate hedge against geopolitical risk. In a world where your currency reserves can be frozen by a rival country, physical gold in your own vaults has no counterparty risk. It isn't tied to any single government's foreign policy. As India's recent move to bring 100 tons of its gold home from the UK shows, there's a growing desire to have their ultimate reserve asset physically secure within their own borders. Second, gold is a hedge against the debasement of paper currencies. Central banks are hedging against the entire model of limitless money printing. In an era of huge deficits and ballooning government debt, gold represents a finite asset that can't be created out of thin air. Central bank buying now makes up a huge portion of total annual gold demand, creating a massive floor under the price. The conflict in the Strait of Hormuz will only make this logic more powerful. It's the physical manifestation of the exact risks these central bankers are trying to insure themselves against. When nations see the global financial system being used as a weapon, the appeal of a neutral monetary asset becomes overwhelming. The frantic accumulation of gold by the world's central banks isn't just a market trend. It's a vote of no confidence in the long-term stability of the current system. These institutions are sending a clear signal. They're getting ready for a world where the value of paper money is no longer guaranteed. So what does this drama of geopolitics, oil tankers, and central bank gold buying mean for you? This requires a shift in mindset. For 80 years, we assumed the financial system was stable. In a stable system, normal positioning works. You invest, you save, you just try to get the best price. But now, the system is stressed. When a system is stressed, neutrality matters. You want to own assets that can't easily be controlled, devalued, or frozen by one side of a conflict. You prioritize resilience. And if the system starts breaking, then access matters more than price. Price is what you see. Access is what matters. This is the new reality. The era of smooth, cheap global supply chains may be ending. The crisis in the Strait of Hormuz shows that the arteries of global trade are fragile. As the world splits into competing blocks, we can expect more friction, more volatility, and higher costs. This geopolitical inflation will likely be a permanent feature of the economy. It means paying attention to geopolitical headlines. An event that happens in a narrow strait of water, half a world away, isn't a distant news story. It's a tremor that will be felt in your own finances. It means understanding that de-dollarization and central bank gold buying aren't abstract theories. They are powerful currents reshaping the financial ground beneath our feet. The test that's happening right now in the Persian Gulf isn't just for soldiers and sailors. It's a test for all of us. A test of our ability to understand and adapt to a world where the value of money is no longer a given, but a question. The forces shaping this new financial world are complex and they're always changing. If you want to keep connecting the dots between geopolitics and your finances, make sure you subscribe. But I want to know what you think. What do you believe is the biggest threat to the dollar's dominance? Let me know in the comments below. The story of March 2026 is not just a story of a war. It's the story of a system reaching its breaking point. It's a live stress test of the dollar-centric global order, and it's revealing the deep fractures that have been forming for years. The ships trying to pass through the Strait of Hormuz carry more than just oil and gas. They carry the weight of an 80-year-old financial system. And if this continues, because when trust in the system gets tested, capital doesn't wait for confirmation. It moves. You won't be asking whether Bitcoin is a good investment. You'll be asking whether you can still access it at all.